welcome to a brand new episode of Market Manthan powered by ZBiz.com. Well, my name is Shatajanand, and today I have with us a very special guest, Naveen Chandramohan, who is a founder and fund manager at ITUS Capital. Well, today we'll be talking about what is in store for investors amid the volatile swings which we've seen so far in December, a wrap-up of the year 2021, budget 2022, and what are the other key events that investors should watch out for in the next year, that is 2022. Well, Naveen has a career spanning of over 15 years in the financial services sector. He has worked across fund management, fundraising, and fundamental research. Well, welcome to the show, Naveen.
Thanks a lot for the kind introduction, Sishish. Pleasure having you.
Right. Well, the first question I, probably wanted to throw at you is that, I'll probably come straight to the point, and it is that, markets are volatile at this point in time. In fact, if you look at what really happened in the last week and, starting this week, we saw Manic Monday, then a rebound. So there's a lot of volatility happening, and especially this is the last month of the year 2021. So, and if you look at from the highs, we have actually fallen around what 7 to 8%. So how should investors, decode it? Is it a golden opportunity to buy or probably book profits?
So I think we'll have to take a step back at each of this so-called volatile times, right?
Right.
I think the human mind is designed to think in a way to extrapolate whatever has just happened recently. And what I mean by that is over the last 1.5 years, most investors have seen our portfolios move only one way, and that's up.
Right.
It's never a good sign, right? Because it kind of makes you lazy around the way you think about risk. True. So like you rightly said, 7 to 8% correction from the highs, right? But unfortunately, the way market works, the highs are always with the benefit of hindsight. No one knows what the high is, still you get the new high, right? True. And second of all, a 7 to 8% is par for the course. In fact, I always say 15% should be par for the course. And that's how you need to treat equities as an asset class in your portfolio, right? Mm-hmm. So to me, I think this is always healthy. The kind of IPO pipeline, as well as the kind of supply that's coming out, the kind of retail participation, which is actually a good thing, but not so good as the fact that a lot of that is behind leverage as well, because returns are lucrative currently. People have gotten used to these kind of returns. Yes. There is always some amount of washout that should be expected. And we are only getting that at a very, very early stage. In fact, I would want it to be slightly deeper, and I would not be surprised even if we get that, right? So I think one needs to always look at this from a perspective. To say that equities means there is going to be some amount of corrections. The corrections can come from market-driven events or earnings-driven events. And as long as you're focused on the fundamentals and you're investing in companies that show growth, your portfolios will come back okay, right? So that is how I think about it. So in terms of answering your last question, taking money off the table, I wouldn't think of that as a sensible thing to do unless and until you have a trading mindset on, right? If you think of yourself as an investor, right, then you certainly have to look at this from a longer term horizon. I think personally, there are a lot of factors within India that are coming together for the first time in the last 20 to 25 years. Right. So I would say this is a very, very early stage of a broad bull market that we are going to get ourselves into. So if you're a true investor, you would look at this as an opportunity rather than to say, let's get some money off the table.
Right. So golden opportunity. And, in fact, if we recall back in March 2020, the gloom and doom moment for equity markets across the globe, and nobody would have thought that, from there, less than 10,000 Nifty, will be trading around about 17,000, 18,000 odd Nifty levels. So yes, so we never know where the top is or where the bottom is. But in the hindsight, yes, investors should look at the opportunity. I mean, should look at, these dips to get into quality stocks. That is the, word of advice coming from Naveen. So moving on to the next question, we are on the verge of closing 2021 and, another double-digit year kind of equities. So it might not be blockbuster year that we saw probably 2020, where we clocked more than 60-65 odd percent for the Nifty 50. But yeah, again, we'll be closing with double digit gains. So what are your views for the year 2022?
Sure. So, Kshitish, the way that I would like to address that is from a twofold perspective. One is to always zoom out a bit and then
Yes.
to zoom back in to talk about 2022, right?
Right.
So, I'll have to give some kind of history to set certain things into context.
No,
Between
absolutely.
2010 and 2020, right, India was the worst performing equity market, right? Not many people are aware of it, but Nifty grew by 7%. That's the worst decade for equities ever, as far as India is concerned. And typically, these are markets operate in cycles, whether one acknowledges this or not. That's the way markets do operate. And US was in the best cycle ever in the last decade. S&P has compounded at 19.5% over the last decade, which is unheard of for
Unheard
S&P.
of.
And I think that is bound to reverse. So if you were to ask me over the next decade, what are my odds? I would say US underperformance along with India outperformance. It's counter consensus. Pretty much everyone that I know of today is looking at, you can call it, use a fancy word like diversification, but end of the day, people want US, right? And I would not be on the same camp as far as I'm concerned. So from a broad perspective, I think there are 5 factors at play that are really coming together for the first time in India. First, our generation and the previous one is not used to this interest rate environment. So when I came back to India in 2017 to set up ITUS, a typical conversation was like, hey, what are you doing with equities? Maybe mid teens IRR at a base case. My FD is at 11.5%. Today, that conversation is completely diverged, right? So that also not only just impacts how you invest, but also the cost of capital from a corporate perspective. And that's changed meaningfully. Second is, today, corporate India's balance sheet is delevered for the first time in the last 15 years. I have not seen corporate India's balance sheet delevered to this extent. What this means is, when private capex, and you're already seeing that aggressively coming into the system, when private capex is getting spent on the ground, that's on the back of a cleaner balance sheet and lower debt. And one thing I always like to remind investors, no one has gone bankrupt who's not borrowed, right? You first need to borrow to go bankrupt. So when your debt is low, when you spend on private capex, it's on the back of demand revival. These are good things. Third is, while you can always comment on the stability of the government and not going to the political side of things, for the first time, there is intent in spending on infrastructure on the ground. If you look at public state capex, the first half of FY22 is actually 15% higher than the first half of FY20, which is 2 years back. So I'm treating the COVID year as a washout, right? So along with this, right, you have capital that is coming in from the new gen because wealth is getting created. When all of these factors come together, which is why I'm making a very strong statement that the next 10 years will belong to equity markets from a public markets perspective. Okay? So like now, this is the base case hypothesis that we actually function on. Now, around this, like you said, you had a really good, strong year. And 22, I think people should price in slightly higher volatility. People should price into the fact that there could be multiple rate hikes. Is that bad for equities? I don't think so. When it is backed by demand growth, it is good for volatility. It doesn't mean that it's bad for equities, right? So, end of the day, I personally think from a base case in 22, as long as you construct portfolios from a cash flow growth perspective, you should see a mid 15 to 18% base case growth in your portfolios from an earnings perspective. Whether that translates into returns, that
is
you will
something
see.
that needs to be seen. Yes. No, absolutely well said, Naveen, on that front. And we are closer to the end of the year, and yes, whenever the new year begins, the first event to watch out for is definitely budget. although, with the coming of GST, most of the the surprise factor has gone. But what are your expectations from the upcoming budget this time around?
So I think the government has been fairly proactive in communicating this time around what they should expect, or what investors should expect, what corporate India should expect, right? Be it in terms of the PLI schemes flowing into some of the other sectors, like let's say battery manufacturing or auto, or let's say, I mean, there is a consensus view that we will raise rates. My view is I think the RBI will err on the side of caution. And I think we are going to make the ability in terms of setting up business and the ease of doing business a lot more cleaner in India, right? And I would expect steps to be taken in that direction. So you're already seeing, for example, EC clearances having the highest number over the last 3-4 years. You're seeing new company registrations clock the highest number over the last 3 years. GST numbers, like you rightly pointed out, are on the positive trajectory, right? So I think there is going to be divestment. There is already divestment happening on the ground. People, skeptics can complain saying that it is slower than normal, but that's fine, right? As long as the trajectory is on the right path. I think I wouldn't say the budget is a make or break. A budget is an enabler for you to move in the right direction. And the direction has already been set, right? So rather than saying all my eyes are on the budget, I think what my expectation is more of the same. As long as we continue to execute on the path that we've set, I think we are on the right track already.
No, absolutely. And, you're right in pointing out that government has been fairly communicative, especially in times of COVID, bringing the PLI schemes and everything. So they are on the right path. And the message which clearly comes from the government is that they mean business, and they are willing to reach out to, corporates to extend whatever help that they can. Also, something related to the first question, any sectors you think that probably, could hog the limelight? Definitely Make in India would be one of the, prime focus areas for government this time around. What are your views on that?
Sure. So I think for us at ITUS, we've always been company first, sector second. We don't operate from a top-down perspective. But however, because of our portfolio construct, you automatically have exposure to certain set of sectors, right? So I think the concept of consumer and tech coming together in India for the first time is what I call a multi-year trend. Right? People can always look at valuations and complain about the fact that, oh, it's expensive. But end of the day, when you are creating the kind of businesses which are almost proxy monopolistic in nature, right? These businesses are not meant to be available cheap, right? So end of the day, this is a very strong trend. And we are in the very early stages of these kind of trends in India. So I would say anything around consumer, at the intersection of consumer and tech, is a very interesting space. Anything around digitization. I think people have thought about digitization as, okay, COVID is, if we are towards, let's say, the last stage of COVID, digitization is over. I think there is a certain perspective around how businesses are looking at digitization. And I think this is again a multi-year trend. Third is a lot of pharma companies with a domestic manufacturing base in India. I think you're going to see a significant shift around how they benefit because of manufacturing capacity moving to them. So the concept of China plus one is kind of abused today, because everything in India has become China plus one. I don't think China is basically in a place where they are saying they'll just stop and everything here. Business, let's take business in a platter to India. That's certainly not what's happening. But there are pockets in pharma with a domestic manufacturing base where you're going to see these businesses continue to expand. And finally, I mean, this is again, I'm not going to talk about anything new, but I think private sector banks will benefit through all of this, right? So you are going to see banking getting consolidated and certain banks benefiting out of this. So I think that's a theme that is an interesting multi-year trend as well. So you would see our portfolios having exposure to these broad themes.
Right. And another thing which you also highlighted, that you run a fund and you run a multi-cap focused fund. So help us understand your fund philosophy. I mean, what exactly that you believe in? When you started the fund, how do you pick stocks and so on and so forth?
So, Kshitij, we're now completing 5 years as a fund, right? So when I look back, so it becomes even clearer today.
Yes.
Today, as an investor, Kshitij, where would you go to? Everyone wants to go and invest in startups or VCs. Private equity has been a trend among the investment class for the last 20 years in India. Now,
Yes.
why do you go towards this space? Predominantly because you want to buy growth, right?
Yes.
This is the only thing that is sold in this space because they are high growth companies. Now, the
Absolutely.
moment you come from this pocket into public markets, the
Mm-hmm.
fund management world has operated and shifted the narrative into a valuation first framework,
Yes.
right? Right. So I'll give you an example. 6 months before the Nika IPO, I had
Mm-hmm.
multiple investors saying, I'm willing to pay any premium to own Nika. I want
Okay.
shares. And it was not available in the market, right?
True.
The moment the company lists,
Hmm.
the same investors, the narrative moves like, oh my God, the valuation is expensive. Nothing changed, right? So, unfortunately, public market investing, because of the fact that the price is seen on the screen on a daily basis,
Right.
you react to a valuation first narrative rather than a growth first narrative. And
True.
that, I believe, in its essence, is the white space we are in. So when I say we look for cash flow growth companies, we
Mm-hmm.
are basically saying businesses which have two levers. A, an ability to convert their profits into cash flows,
True.
and B, have a good return on capital, which is, let's say, 1.5 times, for lack of a better number, over the cost of capital. When you have these two things in tandem, you
Mm-hmm.
have the potential to invest in a company
Okay.
for slightly longer periods of time, right? Because you have stability in terms of the core balance sheet,
True.
right? So these are the kind of businesses that we look for. The reason this is a white space is
Mm-hmm.
because these are not cheap. So the
Okay.
moment you put on a metric of saying, I want to buy cheap on top of this will not come into your radar at all. Right.
Right.
So you have to learn to pay up to own these businesses. The only question is, where do you pay up and where you don't, right? And that's
True.
where we come in. So that's the basic metric around which we construct our portfolios. And we
Right.
feel, end of the day, multi-cap is the best way to do it. And that's the reason we run only one fund.
True. Any checklist that you follow for picking stocks for your portfolio?
So our first checklist, like I highlighted in our previous conversation, right? It is around cash flow growth.
True.
Now, why cash flow growth is important is because I can manipulate revenue growth. I can manipulate PAT growth. EBITDA growth is the worst metric that anyone can look at because it's the most manipulatable. But the hardest thing to manipulate is cash flow growth. Right? And history tells you that. You don't need to listen to me. There are
True.
only two companies that have manipulated that as well in the history of mankind. One is Enron, second is Satya. Right? It requires a
Yes.
concerted effort from multiple people in the system to manipulate this.
True.
Once you have this, then you go into the underlying business. Right? What's the competition in this particular landscape? Is the
Right.
market share in this particular business growing? Who are the
Mm.
promoters and what's the management? Who are the
True.
auditors in terms of the partner who's signing off? What kind of related party transactions are within this particular business? Are there any? If so,
Mm-hmm.
that should raise some red flags.
Sure.
Then we go slightly deeper on the ground. We basically talk to the distributors of the companies, the channel partners, the suppliers.
Okay.
We go to the extent of also talking to the ex-management who may have left the firm. The
Okay.
reason that is important for us is because we are not investing in just the business, we are investing in the people and the culture that they have created. Right? So it's important for us to do this. And finally, it's the
Mm.
valuation. Right? So for us, valuation comes third down the pecking order rather than the first.
Right. In fact, so the checklist will also apply to the the new age companies that have just hit the system.
Absolutely, right? So end
Absolutely.
of the day, new age or old age doesn't matter. Again, that's a word that we've coined, right?
Right.
End of the day, a business is meant to grow its cash flows. If it can't do that at a unit economic level, then you'll have to question what they're doing. And if it has to be run by a set of promoters who are supremely passionate about what they're doing. So
Yes.
none of this changes whether it is new age or old age.
Right. No, by new age, we meant to, specify companies who are well known, but then again, at the end of the day, they might not be making that kind of profits. But yes, they are displaying growth levers, for probably for the next 5 years or 10 years. But history has also shown that first mover advantage is fine, but then again, the companies who are able to sustain themselves might not be first movers, but they learn from the first movers, and then they sort of come up with a better business idea, making profits. So yes, uh, and finally, I think it's a very interesting question. I wanted to put it across to you as well. uh, the new investors who have joined the party on B Street, especially after the pandemic, what would be your advice? Because as we pointed out that both Sensex and Nifty have seen a drawdown of 7 to 8 odd percent, and history tells us that it's not kind to the sort of drawdown seen in the past as well. A big correction usually takes the confidence away from the retail investors, and this is the first time that we have seen SIPs increasing so much, 100 billion per month, and that is the kind of mammoth money which is coming into equity markets via mutual funds. That is just the mutual fund that I'm talking about, and not the the trading volume that I'm talking about. Uh, there's so much of confidence in this market at this point in time. Do you think that any event would be able to shake it? That's the only concern that probably we foresee, because 2007, 2008 periods have not been nice, and it took some time for retail investors to come back to equity markets.
So I think two aspects, right, Kshitij? One was advice, and advice is a very dangerous word to use, because you give it today, and then if you're not consistent around this, it is of no meaning to anyone. True. So the only thing that I would say is look at the previous bull market, and the most recent one is in the US in the last 10 years, right? In this 10-year decadal bull market in the US, which was one of the biggest bull markets US has ever seen, S&P as an index, I'm not talking about individual companies, I'm talking about S&P as an index, corrected more than 20% 5 times. Right. So when I'm basically zooming out and saying the next decade should belong to India, I'm also overriding it with the fact that a 20 to 20% plus correction should happen at least 5 or more times. Right. So what that means is, just because someone says it's a bull market in the making doesn't mean you're not going to have drawdowns. What public markets tests you is the ability for you to stay invested for the next 10 years. Right. The only way you can do that is twofold. If you're doing it yourself, which is perfectly fine, focus on the company's business model, right? Many people talk about stock ideas. The only thing that I'll ask them is at least make an effort to know who the CEO of the company is, because that's the basic thing that you need to do. If I say that you have to buy a Louis Philippe shirt, you will know exactly at what price each shop is selling it, or what it is available at Amazon. If you're investing in your hard-earned money, at least try and figure out who the CEO of the company is, because end of the day, he's your capital allocator into which you're investing. Second, if you can avoid leverage, please do, because this is not a market for where you lever up in order to make additional returns. It's you make returns through giving it the benefit of time, not by trying to. It's not a quick rich scheme. So if I was to basically leave investors with two themes, this is what I would say.
Well, interesting line, Naveen, that you've thrown is the next decade belongs to India, and I'll stick to that line. But for now, thank you so much for your time, Naveen, and insight on markets and where investors should be putting their money. Well, to get in-depth coverage, stay tuned to zeebiz.com on desktop or mobile for more on news, business, and economy. Again, thank you so much for your time on that note.
Thanks a lot for your time, Kshitij. It was a pleasure interacting with you.
Same as.